Okay, so you're prepping for this exam, right? And you're really zeroing in on technical analysis,
Yeah.
specifically price trends and volume and market internals.
Absolutely. Those are really key
It's
areas.
huge. Yeah. So think of this deep dive as like a super focused study session.
Yeah, I like a targeted review.
Yeah, exactly. You're going to pull out the core concepts, the relationships, the stuff you absolutely need to know.
Yeah, cut through all that noise and highlight the most important stuff.
Right. And we've got some great material to work with here, breaking down
Yeah, we do.
price trends and volume and then market internals.
Right, those are the two big sections we want to focus on.
Exactly. So our mission today is crystal clear. We're going to give you a concise overview of these topics.
Yeah, and hit those definitions and how to interpret them, right? Because that's what's going to be on that exam.
Yes, and most importantly, how they actually apply in the real world.
Right, exactly, because that's how you're going to use them.
Yeah, so you can actually use this stuff to make informed trading decisions.
That's the goal.
Right. All right, let's dive into the foundation here. The interplay of price trends and volume.
Okay, yeah.
Our sources really emphasize that price trends are like a visual story of how investors are digesting information.
Yeah, I like that the market story unfolding in real time.
Right. It's the market talking to us through price.
Yeah, and volume is like the exclamation point on that story.
Right.
It shows us the conviction behind those beliefs.
Oh, I like that. The exclamation point.
Yeah, because volume is about the actual money flowing in or out.
Right. It's not just about the direction, but the force behind it.
Exactly.
Mm.
You know, prices don't just change randomly. It's
No.
capital-seeking returns.
It all comes back to supply and demand, right?
Always, yeah.
So when we look at price and volume together, what we're really tracking is accumulation, which is that demand building in an uptrend,
Right.
and then distribution, which is supply taking over in a downtrend.
It's that constant push and pull between buyers and sellers.
Right. And then a key concept is how we evaluate the strength of these trends.
Yeah, and one of the core principles that keeps coming up is that a trend is assumed to continue until
proven otherwise.
exactly until we see solid evidence that it's reversing.
Right. A little blip here and there doesn't necessarily mean anything.
No, you need a real shift in the weight of the evidence.
Okay, so this is where that airplane analogy really clicked for me.
Okay, yeah.
Imagine a plane needing a certain airspeed and ascent angle to stay up in the air.
Right.
That's your price trend, right?
Yeah, the direction it's heading.
But volume is the engine's thrust.
Okay.
So if the pilot wants to climb higher or faster,
Yeah.
they got to increase the thrust.
You need that power.
Exactly. And if there's not enough thrust, the plane can stall.
It loses momentum.
Exactly. And that's how it is with price trends. If an upward trend wants to keep going, it generally needs increasing volume to support it.
Yeah, that fuel to keep it moving higher.
If the volume isn't there,
Uh-oh.
that trend gets shaky.
It becomes vulnerable, exactly.
And low volume, that's always a yellow flag.
Definitely a warning sign.
It might mean the trend is losing steam.
Yeah, could be running out of gas.
And it definitely makes you question those counter-trend moves or breakouts that happen on low volume.
Yeah, because are they really sustainable if the volume's not there?
Right, exactly.
But on the other hand, high volume, that's like a huge tailwind for a trend.
It validates everything.
Yeah, it's like a confirmation stamp.
Exactly. When you see a price surge or a breakout on big volume, that means a lot of people are behind that move.
Yeah, it has that credibility.
It gives it weight.
Exactly. So
Right.
technicians are always looking for this volume confirmation.
Right, because rising volume in a price trend means growing participation.
More and more investors are jumping on board.
Putting their money where their mouth is.
Right, and steady volume that just reinforces the existing trend.
Says, yeah, this thing's got legs.
But then declining volume,
Ooh, that's a different story.
that's the warning sign.
Yeah, it might be a sign of weakness.
Like the party's ending.
Right, who's left to keep this thing going? Exactly. Okay, so let's get into this framework that I found really helpful.
Okay.
The 4 phases of volume analysis.
Yeah, Harold Gartley's work, right?
Yes, exactly. It breaks down this whole dance between demand and supply.
Mm-hmm.
And it helps you see what's really happening under the surface.
Absolutely. And what's so key to Gartley's thinking is that every transaction
Every single one.
involves both demand and supply.
Someone wants it, and someone's willing to let it go.
Right. It's two sides of the same coin.
Exactly. And when demand outweighs supply,
Prices go up,
and when supply is stronger,
prices go down.
so simple, right?
It is, but people forget that.
They do. So volume during price increases,
That's demand volume,
and volume during price decreases.
supply volume.
And by watching how these two interact,
You start to see whether there's more buying interest waiting to come in or a bunch of shares hanging over the market ready to be sold.
right. And these forces create those pressure points.
Exactly.
And Gartley identified 4 phases that reflect this.
Okay, let's break them down.
Okay, so phase 1.
Strong demand.
This is your classic bull market scenario.
Prices are rising. And importantly,
With high volume,
yeah, that volume is the fuel.
it's what's pushing that trend higher.
And this phase usually comes after selling pressure has been exhausted.
Right, so supply's been depleted,
And it paves the way for that new advance.
sets the stage for the bulls to take over.
And it's often the start of a bull market.
Yeah, you see those big price swings upward.
And as it goes on, more and more investors buy into it.
They get comfortable at those higher prices.
They're like, yeah, this is the place to be.
Right, and technically you see those higher lows in price.
And the volume confirms it.
It's that fuel for more gains.
Right. Okay, so then we move into phase 2.
Weak demand.
This one can be tricky.
Yeah, it's more subtle.
Because if you're just watching price,
You might not notice anything's wrong.
the uptrend might still look okay.
Yeah, you might still see those higher lows.
But here's the key.
The volume starts to decrease.
Yeah, even though prices are still going up, that's the warning sign.
Fewer buyers are stepping up at those higher prices.
Right. The enthusiasm's fading.
It's like the market's getting complacent.
Yeah, those early buyers are happy with their profits.
But new buyers aren't as eager.
So you've got that divergence between rising prices,
And declining volume.
and that signals trouble for the bulls.
Okay, so then phase 3.
Strong supply.
Now this is a clear shift to a bearish environment.
Yeah, the sellers are taking control.
Usually it starts when the price breaks below a key support level.
That's a confirmation that the uptrend is over.
And a new downtrend is starting.
And the key thing here is rising volume.
On those price declines.
Exactly. That's showing you that sellers are motivated.
They're accepting lower prices to get out.
Yeah, they want to unload their positions.
And that rising volume on down days.
That tells you the bears are in charge
Yeah, they're driving the bus now.
and likely to continue pushing prices lower.
Okay, and then finally phase 4.
Weak supply.
This usually happens in the later stages of a downtrend.
Yeah, towards the end of the move.
And you see prices falling often pretty rapidly,
Mm-hmm.
but volume is diminishing.
Yeah, it's drying up.
Most of the selling is done.
Right. The motivated sellers are out.
And it can look like a panic sell-off
Short and sharp,
or a slow drawn-out decline,
where interest just fades away.
especially with individual stocks.
Yeah, people just lose interest.
But it's important to note that with market indexes,
This phase can be less obvious.
more nuanced.
The key is that sellers are becoming apathetic.
They don't even want to sell at these low prices.
Yeah, they're not motivated anymore.
And that lack of selling,
Suggests a potential bottom.
it's like the downtrend is running out of steam.
Nobody left to sell.
Exactly.
And this is what Ralph Acampara talks about
Yeah, this is important.
when prices stabilize after decline.
Mm-hmm.
And you start to see volume increase on price advances.
That's the sign.
We're shifting back to strong demand.
Buyers are coming back in.
The selling pressure is gone.
So let's summarize these 4 phases one more time.
Right.
Strong demand.
Rising prices, rising volume.
Bullish.
Yep. Confirmation of strength.
Weak demand.
Rising prices, falling volume.
Bearish divergence. Watch out.
The warning sign,
Strong supply.
falling prices, rising volume.
Bearish confirmation.
The bears are in control.
And weak supply.
Falling prices, falling volume.
Often a bullish divergence.
Yeah, potential bottom forming.
This stuff is so important for understanding the market.
Absolutely, it's fundamental.
Okay, so now let's switch gears a bit and talk about market internals.
Okay, yeah,
Now, analyzing individual stocks is crucial,
of course, yeah.
but market internals give us this bigger picture view.
It's like zooming out and seeing the whole landscape.
Exactly. It's about the health and momentum of the whole market.
Yeah, not just one specific stock.
Right, and it's about looking beyond those major averages.
The S&P 500, the Dow,
and seeing what's happening at a more granular level.
under the surface.
Exactly.
Yeah.
So market internals show us the collective behavior.
Of a whole bunch of stocks
And they can reveal strengths or weaknesses.
that you might miss if you're just looking at the indexes.
Right, so there are tons of these indicators.
So many.
But we're going to focus on the ones that are most important for you.
Yeah, the ones you need to know for the exam.
Right, the most likely to show up.
Absolutely.
Okay, so let's start with some basic ones.
Right.
The advanced decline line.
The EDL,
Yes, it's basically a running total of the net advances and declines each day.
or sometimes each week.
Right, and some people try to use it to pinpoint the exact start and end of bull and bear markets.
Yeah, but it's not really that precise.
No, its real power is as a confirming indicator,
Yeah, it helps you validate what you're seeing in the averages.
especially over an intermediate time frame.
Right. And our material actually is a good example of this.
Yeah, figure 5.2.1. It shows how the ADL moves with the market.
It's a nice visual.
And it's also helpful to use it with other indicators.
Yeah, like a stochastic oscillator.
That can help you with timing those market turns.
Right, getting in and out at the right moments.
And what's interesting about the ADL is how it acts around market turning points.
Yeah, it can help you spot those big tops and bottoms.
Yeah, but it often lags behind the indexes at bottoms.
Yeah, that's important to remember.
But it makes sense if you think about it.
Yeah, markets tend to top out slowly,
It's a gradual process.
but bottoms are sharp and quick.
Like a sudden drop.
Exactly.
Okay, next we have up and down volume.
Okay.
This looks at the volume on upticks versus downticks.
Yeah. How much volume is happening on price increases and decreases?
And you can look at them separately or as a net figure.
Up volume minus down volume.
Right. And our sources suggest that it's most useful as an average.
Yeah. Smooth out the daily noise.
Exactly like a 13-day EMA.
And that's what they show in figure 5.2.1.
Right, so just like the ADL.
Up and down volume can tell you about the health of a trend.
And again, divergence analysis is key here.
Always looking for those clues.
For example, if the market's hitting new highs,
But up volume isn't keeping pace.
that's a warning.
Yeah, the bulls might be losing steam
And the same thing in reverse during a downtrend.
if down volume is shrinking.
That could be a sign of a bottom forming.
The selling pressure is easing.
And remember, the key here is to pay attention to who's driving the trend.
Right. Who's in control?
In an uptrend, you want to see up volume supporting the price advances.
Yeah, that's confirmation.
But if it starts to fade...
Uh-oh, the bulls are running out of gas.
Exactly, and in a downtrend.
You're looking for divergences in the down volume.
Right. Are the bears losing their grip?
Is the selling pressure drying up?
That's what you want to know.
Okay, so next we have breadth indicators.
Okay.
These are all about short-term momentum and participation.
How many stocks are joining the party?
Exactly. It's
Yeah.
about the breadth of the move.
And extreme readings in these indicators can signal.
New trends starting or existing trends accelerating.
So one example is the absolute breadth index.
Norman Fosbach's creation.
It's a 10-day SMA of the absolute difference between advancers and decliners.
That's a mouthful.
It is, but the idea is that strong market moves
Whether up or down,
tend to have a lot of uniformity.
everyone's moving in the same direction.
Right. So high readings in this index.
In a very one-sided market.
Either lots of advancers or lots of decliners.
And that's usually bullish.
Yeah, it shows conviction.
But low readings.
Mean a split market.
Advancers and decliners are kind of mixed.
And that's bearish.
Yeah, it shows indecision.
And that split market idea.
We're going to see that again.
It often means trouble.
Okay. And then there's the advance decline ratio.
This one's pretty straightforward.
Yeah, advancers divided by decliners.
And traders watch for certain levels like 5.1 or 10.1.
Yeah, those are big signals.
It means there's a lot of one-directional activity.
And it could be the start of a big move.
Okay, then we have 80% and 90% days.
Okay, so this is about the percentage of advancing stocks or declining stocks.
Out of the total.
Right, so 80% up day means 80% of stocks went up.
Exactly. And you can do the same thing with volume.
Up volume and down volume.
So these extreme percentage days.
They show strong momentum in one direction.
Yeah, like everyone's on the same page.
Right.
Okay, and finally for breadth, we have the percentage of stocks above their end day average.
Okay, this one tells you how many stocks are trading above a specific moving average.
And the most common ones are the 50-day and the 200-day.
50-day for the intermediate term.
200-day for the long term.
Right, and this indicator is great for seeing the strength of a trend.
And you can use it for different things.
Yeah, broad market averages, sectors, individual exchanges.
It gives you that granular view.
Okay, now let's talk about leadership indicators.
Okay.
These focus on new 52-week highs and lows,
Right, and unlike some breadth data where cumulative measures are helpful,
like the ADL.
the raw numbers for new highs and lows are actually more useful here.
Yeah, don't overcomplicate it.
So one way to analyze this is just by tracking the raw number.
How many new highs each day?
How many new lows?
Simple.
Another way is to look at the net data.
New highs minus new lows.
You can plot that on a chart.
Or express it as a percentage of total issues traded.
And this leadership data is great for identifying turning points.
Yeah, through divergence analysis.
So a classic bearish divergence.
This is when the market keeps making new highs.
But new 52-week highs are declining.
Yeah, fewer stocks are participating.
It's a sign of weakness.
And the opposite can happen at bottoms.
New lows start to decrease even though the market's still falling.
Could be a sign that selling pressure is easing.
And this divergence analysis works on daily or weekly data.
It's a versatile tool.
Okay, now Gerald Appel, who created the MACD,
Oh, yeah.
he also came up with the percentage of new highs.
Okay.
It's a 10-day MA of new highs divided by new highs plus new lows.
Another mouthful.
It is, but it's mostly used with exchange level data.
Like the NYSE.
And it can show you if a rally is weakening.
If it drops below 70% after being above it,
Or it can highlight potential buying opportunities.
when it crosses above 30% after being below it.
Okay, now let's get into the advanced indicators.
All right, buckle up.
The ARMS index, also known as the Triine index.
It measures the relationship between volume and advancing declining stocks.
It's a bit of a complex formula.
Yeah, but the neutral value is 1.
And readings below 1 are bullish.
More volume behind the advances.
And readings above 1 are bearish.
more volume behind the declines.
You can use it daily or as a 10-day average.
Depends on your time frame.
Okay, next up, the McClellan indicators.
Okay, 2 of them.
First, the McClellan oscillator.
It's the difference between 2 EMAs of net advancers,
One short-term, one long-term.
usually 19 days and 39 days.
And it oscillates between plus 100 and NX to 100.
It's an overbought, oversold indicator.
And extreme readings can signal strong momentum.
Yeah, and potential trend changes.
Then there's the McClellan summation index.
This one's a cumulative total of the oscillator readings.
So it's a longer-term indicator.
Yeah, helps you identify those major
Yeah.
tops and bottoms.
Okay, now for something a bit rarer.
This is wide breadth thrust.
It's a 10-day MA of the percentage of advancing stocks.
And the signal is when it goes from below 40% to above 62%.
That's a big jump.
It is, and it's pretty uncommon.
But it often happens at the start of those big cyclical advances.
Yeah, it's a powerful bullish signal.
Okay, now the Investment Research Institute,
They have this interesting approach
they use what they call 90% days.
to spot bear market bottoms.
The idea is that bottoms have 2 phases.
Selling panic and buying panic.
So they define selling panic.
As a day with 90% declining stocks and 90% down volume.
Ouch, that's intense.
It is.
And then they look for buying panic.
Which could be one 90% update.
Or multiple 80% up days in a row.
Those are signs of a potential bottom.
Okay, then we have the 40.1 ratio.
This one's simple.
New lows divided by new highs.
It's a yes or no signal.
And it usually flashes yes when new lows are way bigger than new highs.
Often happens on those 90% down days.
And that points to a potential panic bottom.
Okay, now Norman Fosback, he also created the high-low logic indicator.
Yeah, in addition to the absolute breadth index.
This one takes the lesser of new highs or new lows.
Divides it by total issues traded.
And the readings are usually very low.
Less than 1% offer.
And the goal here is to find split markets.
Where you have lots of new highs and new lows at the same time.
And Fosback says high readings here can mean instability.
Okay, and finally, the Hindenburg omen.
This one's controversial,
It's supposed to warn of market crashes.
but some people don't trust it.
Yeah, lots of false positives.
But it's worth knowing the criteria.
Okay, so for it to trigger
The market has to be in an uptrend.
50-day MA rising.
The McClellan oscillator has to be negative.
And the high-low logic has to be above 2.2%.
That split market thing again.
So if all those things happen,
It's a potential warning sign.
but take it with a grain of salt.
Yeah, don't rely on it alone.
Okay, now beyond these specific indicators,
There's also qualitative analysis.
it's about looking at the bigger picture.
The patterns and shifts in behavior,
So one approach is to watch for range shifts.
like Connie Brown talks about with the RSI.
You look at the typical range of an indicator.
And if it starts to shift,
That can be an early warning of a trend change.
for example, if during a bull market
The percentage of stocks above their 200-day MA,
is struggling to stay above 40%,
that could be a sign of weakness.
even if the market's still going up.
Right, it's like a hidden crack in the foundation.
Exactly.
Okay, now another way to think about market cycles.
Is to use seasons as an analogy.
Spring and summer are bull markets.
Growth and expansion,
Winter is a bear market.
and traction decline,
And this works because markets tend to cycle through these phases.
just like the seasons.
Bull markets usually last about 3 years.
And bear markets about 1 year,
So in this analogy, we have fall days,
which can warn of a coming winter.
a major market top.
A fall day is basically the first big surge in new 52-week lows.
During an established bull market.
One that's been going on for a while.
And while one fall day isn't a sell signal,
Should make you cautious.
start watching for other warning signs.
Divergence is weakening price action.
Then we have spring days.
These help you spot new bull markets starting,
And there are specific criteria for this.
often involving market breadth improving,
Like the percentage of stocks above their 50-day MA going above 80%.
and the percentage above their 200-day MA going above 40%.
Both of those need to happen.
And ideally hold for a while.
And using weekly data can be helpful.
Gives you a clearer signal.
So waiting for both spring day conditions,
Might mean you miss the exact bottom.
but it can give you a more reliable entry point.
Less risk of a false start.
Okay, so to wrap up,
We covered a lot of ground.
we talked about price trends and volume.
How volume can confirm or contradict price.
Gartley's 4 phases of volume analysis.
Strong demand, weak demand. Strong supply, weak supply.
We went through a whole bunch of market internals.
Basic indicators, breadth indicators, leadership indicators,
Yes.
advanced indicators.
And even qualitative analysis.
Range shifts, seasonal analogies.
So this should give you a solid foundation for the exam.
Yeah, focus on those definitions, interpretations, applications.
And here's a final thought for you.
Okay.
Think about how these two areas, price volume and market internals, can be used together in real-world analysis.
Yeah. How do they complement each other?
And which indicators might be most useful,
In different market conditions.
or for different time horizons.
Really good questions to ponder.
Exploring those connections will deepen your understanding.
Absolutely.
Good luck on that exam.
You got this.
Thanks for joining us for this deep dive.
It was fun.
And we'll see you next time.
See you later.